Mr. Beaty. How are you?
I'm well, thank you.
When I was kind of going through, okay, we have 20 minutes here. What do people want to know about from Ross that maybe they haven't heard already? And then one of the things that all the interviews that we did on Mining Stock Daily in 2024, there was a lot of different themes, a lot of news, a lot of good things happening. Obviously, tailing higher gold price, higher silver price, copper for the most part, you can say. But one of the themes that really kind of was interesting throughout 2024 was mine building or mine acquiring. And so I thought this might be an interesting discussion to have with you, somebody who's created billions and billions of dollars in value over your career. But having that discussion about the trials and tribulations that you've had in building mines, you make it look so flawless sometimes. Is it always this easy?
Well, first of all, good morning, everybody, and thank you very much for coming here. It's for me, you can imagine, it's very gratifying to see lots of people here, and I also know a lot of you are shareholders of mine in different companies. My main company, of course, today is Equinox Gold, but I'm also very, very active in a smaller junior called Lumina Gold. And I know many of you have shares in these companies, and so I want to thank you for that and just for being here to listen to my stories. I'm going to spend about 3 hours answering that question because I've been in this game for almost 40 years, running public companies, 15 companies. 4 of them were large, mining companies, or 3 were large mining companies like Equinox, and 1 was a large renewable energy company that I founded all of them. And that I think those are the ones you're really talking about when you say what are the pluses and minuses of development, because the other companies I've had, like Lumina Gold, are more explore, develop, and sell. Those have been a different kind of business without getting involved in operations and having a big income statement, balance sheet, and all the trials and tribulations that brings. So, probably the best, I could talk about, companies like Pan American Silver that I founded, and it's now a huge company. I think Pan American has 24,000 employees and 11 mines in 6 countries. So it's a pretty big company. But Equinox Gold is heading there. That was the model for building Equinox Gold right from the start. We began it 7 years ago, almost this month, early 2018. And that was a company, Equinox is a company that was built from the ground up to give investors superior leverage to the gold price. Superior leverage meaning, if gold goes up 10%, Equinox Gold goes up 20 or 30%. And you get there by focusing on 2 things, on building a large production base, as large as possible, and by building a large reserve and resource base. So we started from nothing, just with that big idea, giving investors, trying to build a company of scale, 1 million ounces or more. And here we are 7 years later. We have 8 operating mines. We have 3 big expansion projects at existing operations. We have, to get to here from zero, we've raised a lot of money. We've put a lot of debt on our balance sheet because debt is a form of, development capital that doesn't cost shareholders equity dilution. We have, we started out without a balance sheet, without an income statement, just with a big idea. And we went to acquire mines because it's faster to build a company of scale by acquisition. So we bought a mine in California. We built a mine in Brazil right after that. We then bought Leagold, and that brought us 3 operating mines in Brazil, 1 operating mine in Mexico. We sold one of the mines in Brazil. We built another mine in Brazil, so we've built now 4 mines, sold 2 mines, acquired 2 companies. And, this has all cost billions and billions of dollars. So finally, I'm going to kind of fast forward. It hasn't all been straight up. We've run into all kinds of problems. We had a lot of social problems at one of our mines, our Mexican mine, where we inherited some agreements that were just not commercial. And we've been working really hard to try to fix those agreements that work for us and the local communities. We had a landslip last year at one of our mines in Brazil. That hurt us. And then we spent $1 billion in May last year buying out our partner at our new mine in in Ontario called the Greenstone Mine. So, you do all that stuff. You build a company. We produced just under 600,000 ounces last year. We're absolutely on track to get to over 1 million ounces really soon. And that's been our focus from day one. So very much we're on track for that. But mining is a very tough game. And you hit these reality checks of nature and people and engineering issues. It's just a risky business. One of the ways you solve risk is by having a diversified portfolio. So for example, we've seen in the last year, we've seen some pretty big train wrecks with one asset companies. I could name a few. Or pretty bad train wrecks with respect to countries going upside down, like Panama. Just destroying value of a huge copper deposit. So the answer to that kind of risk issue is scale. Diversification in location, in number of assets you have. You don't want to have too many, but you want to have enough to be able to offset risk when it happens. But you also want to have that reward potential. And so by sticking close to that mission of scale, multiple assets, the new assets like Greenstone being better than the other assets we acquired, you eventually build a good-sized operating company that's going to be around for a very long time and offers really good shareholder wealth appreciation. And I think that's very much where we're at right now. We've built Greenstone. We've got a very good future ahead of us. We'll be paying down a ton of the debt that we've incurred to get to this point. This year, we should be really strong in free cash flow this year. And so I'd say the story's pretty good right now. I'm feeling really comfortable with 2025. And future years. And of course, I'm still very bullish on the gold price. Certainly, that has performed well. Gold started, when we started Equinox, gold was $1,350. Today it's $2,700. And so that side's been pretty good. And the next step is to reward shareholders for their investment in Equinox.
I think you just answered every single question I had in a matter of a couple of minutes, Ross, so this might be a wrap. No, I'm just kidding. But there's a couple themes that in there that I did want to kind of open up with you a little bit. I want to talk about your thoughts on companies going from explorer developer to production, and maybe through the acquisition of a producing asset or through the permitting, the financing, the permitting, and the building itself. When you see other companies, what do companies need to make that jump? Is it management, access to capital, all those things? But what are the red flags you would see when, say, these companies are not prepared to go into that next level of mining? Yeah.
So on this floor today, there are, I don't know how many companies, 100 companies here? 50, 80 companies? Anyway, there's a lot of really good companies. There's a lot of excellent exploration companies, small cap, junior companies. And so your question really is, how do those assets get to operating mines? Well, the first part of that question is most of them won't. Right? It's a really tough business, and you need 1,000 exploration prospects to make one mine. There's so few mines around. So most of these companies actually won't have projects that ever become mines. That doesn't mean they won't make shareholders a lot of money at this point. Because, for example, when I was doing all the Lumina copper companies, we had 6 companies, and I think 10 different copper deposits. We sold every one of those companies for billions of dollars. But only one out of those 10 copper deposits that we sold, only one is currently in production. We sold a company to First Quantum in Argentina for $450 million called Taca Taca. It's still undeveloped. We sold a copper property in Peru called Galeno for $500 million. To a Chinese syndicate. That's still undeveloped. That was back in 2007. So we sold it, and we sold another one to Teck, and that's still undeveloped in Chile. So, just because a property doesn't become a mine doesn't mean it isn't going to offer value at that stage of the cycle to where a company like here would sell a property or the company itself to a larger company for a really great premium. So that's the first thing. You don't need to build a mine to actually have value. And then, of course, if you increase your reserves, and resources and make a new discovery, even if it's not actually going to become a mine, it's going to excite the market, and you're going to have a lot of people piling in. That's a wonderful, wonderful time of the cycle to be invested in these companies. And again, lots and lots of those are here. To actually build a mine, it's hard work. It's really hard work, and it is soul-destroying work. An example is a junior company that I've been involved with for a long time in Ecuador called Lumina Copper. We've been to the first of all, the deposit is fabulous. It's huge. It's low grade, but it's in a great location in Ecuador. We're doing a feasibility study. Wheaton gave us $300 million to develop the mine, and they did a ton of due diligence. So the technical side's black and white, but we simply cannot get that stock up to the level that it should be at. It's trading for 140 million US, and it's got a net present value of about 5 billion. That's an example of the disconnect right now in the market. And so a lot of people are saying, well, you'll never be able to finance the $1 billion or so it's going to take to develop that mine. Well, we're not going to do it. Someone else will do it. We've had the company for sale, and we almost had a sale a year ago. I was quite confident, actually, we were going to sell the company last year. We've been to the altar 3 times in the last 4 years. 3 times. And for one reason or another, we just never got over the line to actually sell the company. But it's that kind of company that you should be looking for to make that gain potential, the premium that comes out of a takeout, of a sale of a good deposit like that to a major company. And there's lots of those around. There's lots and lots of those around. The reason we don't want to develop it ourselves, now, we could look at, say, Equinox Gold as a buyer for that. That's something that we've talked about a lot. Equinox has other priorities right now. It's not in the market for that kind of thing right now, but that's the kind of company that could be a buyer. But for me, say, to take that deposit and put it in production, well, the market cap's 140. We need $1 billion of capital. That's a hell of a challenge right there. We've got to get our social license. We've virtually got that, but you've got to prove that. We've got to get permits. We've got to do all the feasibility study work and the engineering work, and then go through 2 or 3 years of purgatory building the mine before it actually starts generating value. So it's really hard work. It takes a long time. It's fairly soul-destroying because the market doesn't like it. You've got this, Pierre Lassonde created this something called the Lassonde curve, where you have this value creation during the exploration phase. You kind of peak when you've got your exploration story over, and then if you go into development, you've got this horrible lingering 3 or 4 year period when you do a feasibility study, get your permits, get your social license, get your financing put together, and then you build the mine, and then finally, when it starts producing, 5 years later, you get that second wave of value creation as an operating business. Tough, long-term. Very few shareholders have that patience to be invested there, especially today, when there is so little capital in this business. So little capital, because most of the money in the stock market today in this sector is what I call dumb money. It's ETF money. It's algorithmic traders who really don't care what the value is. It's momentum buyers. Again, they don't care what the value is. They're just doing sectoral movements of money. They want liquidity. They want to be able to get in and out. They want to have momentum. There are funds that trade off of news release words. That's all they do. A computer scans a news release. If it's got words about failed or didn't meet or any of those sort of things, bang, they hit a sale order and the stock gets crushed, even though the fundamentals can be fabulous. So we're adding one more tier of difficulty. Recently, there's just so little capital, investor capital, and that's why for you in this audience, coming to a conference like this and hearing these kind of stories is really, really valuable, because you are the value investors. You are looking at quality, and you want to have good management, access to capital, good properties, of course. That's at the end of the day the most important. And it's meeting management and screening the fast talkers from the slow talkers with quality that is what you get by coming here. So it's a really good thing to do.
What about the acquisition of producing assets? If you're a company that's never been a producer before, and there's been some fire sales in the last couple of years, and I'm thinking of a couple of specific stories from the last couple of months where these developing type of companies were able to pick up production where when gold was $2,000 an ounce, margins were really tight. But now at $2,700, margins are greatly improved, and now they can buy these assets for a song. They have cash flow, and they can battle those really hard markets of public capital through cash flow to fund exploration development. those stories exist, but is that a good idea? Is that a good idea if you jump right into a production type company through the acquisition, places you've never been before?
Well, again, it's easier said than done, first of all. It's easy to say we want to buy an asset cheaply. It's very difficult to do because very few assets are being sold cheaply. It's a seller's market right now. Newmont went out to sell a bunch of non-core mines, producing mines. They thought they were going to get $2 billion, and they just sold some of them, and they already got $4 billion. So it's prices are pretty high right now. The idea of buying a good company for a song it doesn't exist in the producing sector because the producers have actually had a reasonable move with the gold price. It's the juniors right here at this show. It's the juniors in the exploration business that are still super cheap. I think that's the next sector that will do well. And I was thinking it might actually start to show some life last year. Really didn't. Gold price went bananas. We had a wonderful run in gold, but the juniors are still suffering, and that's the sector I would say should have the best move this year.
There you go.
Yeah.
All right, I want to talk about the mid-tiers, such as Equinox. The margins have just been incredible for you and your peers. I watch these quarterly financials, and it's just printing cash with these margin in gold and silver, most of them anyways. But what do you do with this margin? What's the best case scenario with improved cash flow to provide shareholder? Is it buybacks? Is it more exploration work? Is it, what do you do with it? What's the best case scenario for it?
Yeah, so how do you allocate your capital? First of all, you have to have capital, and that's always tough. But you're right, Equinox, until this year, Equinox didn't have any capital. We were spending like crazy building this big mine in Ontario. We spent $750 million US building the mine, and then in May last year, we spent $1 billion buying out our partner, buying out Orion Gold. And so what do we do with that? We piled on debt. So we have about $1.3 billion in debt. So for Equinox, just Equinox, with all that debt, the very first priority is to repay debt. Get our leverage down to a reasonable ratio before we do anything else, before we buy any other company, before we build any other mines. It's getting that debt down to a livable level. And, it's all where you are in the cycle. We had to incur a lot of debt to build the mines, so we didn't have to give away our stock at cheap prices to vulture capitalists in New York and Toronto and so on. And that's what happens. So if you're a Pan American Silver, you have $1 billion on your balance sheet, no debt to speak of. You have a very different capital allocation decision. Do you buy back shares? Do you pay dividends? Or do you go and build another mine? And those are, luckily, Pan American has these incredible growth assets. It has a huge silver deposit in Guatemala, another one in Argentina, and a great big silver deposit in Mexico. And they're all fabulous silver deposits. So that's really what they're probably going to put their capital into, is that kind of growth to get them back as being, the world's preeminent silver investment.
So it sounds like all of the above.
All of the above, depending on the company.
What's a meaningful time frame to get that debt paid off in your mind?
As quickly as possible.
And
I hate that.
Totally get it. I totally get it. But if you were just a private investor and you involved in a company that's taking on all this debt, do you want to see it gone in 3 years, 5 years?
No, it's all about. No, you can't be explicit like that. It's all about the best place to put your capital at a moment in time. And there could be, next week, I'll just use a hypothetical example. Next week, we could have an opportunity to buy a company that's super cheap, that fits our schedule, fits our development plans perfectly. It just comes up opportunistically. So what's better then, to do that or to pay down debt, right? So you can't be too doctrinaire about that kind of answer. Every company is unique, every capital structure is unique, and of course every cash generation capacity in each company is unique. So it's really hard to be too specific.
We just have less than a minute here. My last question is on dividends, Ross. Is that a great way to attract new value investors back into the gold mining space who have literally been non-existent for many, many years? Yeah,
dividends are good, but there's a lot of studies that the geeks in the investment community can talk about that say that dividends don't necessarily do much to improve the share price of a company. They help, but they're not as good sometimes as paying down debt or buying back shares or building a new mine. Those are all different alternatives for the allocation of capital. And so, you've got to be specific again to the company.
That's all the time we have. I'm sure everybody's got questions for you. Nobody's going to have a question for me, so I'll just let you have it. Thanks,
well,
Ross.
thank you, and thank you all again for all of those who are shareholders of my companies. I appreciate it greatly. You're part of our family, and I hope to be here a year from now. I love coming to this conference. I do this sort of once a year, and I really appreciate your support. Thank you.
Thank you.